Hello, ladies and gentlemen. Welcome back to a common sense analysis with John Money. Um, Sorry, that wasn't funny. Anyways, guys, first order of business, I'd like to say thank you for subscribing and liking things on my channel, specifically my content. I think I have about 120 subscribers right now. That's a big audience for me. So I would just like to extend the gratitude. And then I digress. For me to go back to business, the topic today would be gold. Very, very interesting commodity for me myself. Um, Unfortunately, I have to focus on the South African market because my portfolio does not justify for me to look outside South Africa. So the first thing I'd like to say is that when I do a common sense analysis, if for gold it's a bit different. So what I do is I look at what drives revenue, because in the end of the day, revenue drives earnings per share, and that's like one of the main price drivers for share price performance. In other words, capital gains. So in other words, I think what we should do today is look at the price and quantity numbers that go into revenue for all the gold mining stocks on the gold mining index. And the first thing that anybody should know about gold miners is that they're mining gold, and the current gold price has been flirting with $1,500 per fine ounce, and that's pretty decent and it's pretty high given historic averages, which I actually calculated myself. So from 1971, let me just double check the stats. Yeah, 1971, that was when the gold standard was abolished, right? So after that, I think it's appropriate to use the data after that. So what I did was I looked at data from 1976 to 2019. I came up with a long-term average price of gold of about $915 per fine ounce. That means, in terms of price, gold has been trading above its long-term average, which has been inflation adjusted for about a decade, 10 years, and that's a very, very long time. So that was the first spark of interest for me when I looked at gold stocks specifically. So if we look at the current macroeconomic environment, the reason why gold is so highly priced and why it's supported is, I think there are a number of issues. The first one would obviously be its safe haven appeal. So people use gold as a source of money or to save their wealth instead of being in fiat currency. And I think I've seen some crypto showing similar. They're basically showing similar characteristics, but I would say gold is still the traditional one. We see big money going into gold, and that's why I'd follow gold instead of crypto. And then the two very interesting things for me would be that interest rates across the globe have been relatively low. So if you look at the ECB, because Lagarde is coming into power, I think a lot of people, general consensus would be that interest rates should be going down, and we're expecting a lot of deficit spending. So from that area alone, we could expect, number one, inflationary fears, and interest rates being very low, meaning that government bonds, which were alternatively the I wouldn't say safe haven asset, but it's a safer investment as opposed to stocks, right? This is now yielding lower rates because interest rates are lower. The US as well, the Fed has been decreasing interest rates significantly for the past few years, and there's just no interest in that. So that's why yield chasing investors would rather go for gold as opposed to government bonds. And then obviously, if you just look at the whole socioeconomic issues in the States, Hong Kong, they're having protests and there are fears of recessions, the US trade wars with China. So all of these things have been very supportive for gold. But at the same time, something very interesting is happening in South Africa, which I don't know if people are actually watching or following. But what I've noticed was that the gold mining index is highly leveraged. That's because the gold miners within the index have high operational leverage and financial leverage. So just one example, we saw Anglo Gold up 110% this year to date alone. And that's significant for any investor, of course. But what was very interesting, if you check, I did this research myself, but I have to put in a disclaimer, Perwin's Hoyer did give me the idea. I think his research is a bit further, but what I did was I checked the last 10 years, and the leverage effect is about 3.5 times. So that means if you expect gold to increase by 100%, if you invested into the South African gold mining index, that would give you 3,500%. Very significant. So at first sight, I was in. I was a gold bull. But then I started looking at the gold miners, and I realized there might not be as much value as I expected. So first things first, I looked at price and quantity, as I said. So in terms of price, if you sell your gold, you're selling it in US dollars. So because interest rates have been coming down so much in the US specifically, the US dollar has been weaker. So we saw earnings momentum decrease, So that's one very negative aspect from my side. And then after that, what makes it even worse is that I checked historical data. And historically, gold miners in South Africa would underperform as soon as the gold price hit 1,400 US dollars per fine ounce. So this has not been the case for the past year and a half, and that should be alarm bells ringing. Because if you think about it, right, before I continue, let me put this in there as well. I saw that the standard deviation of gold miners, so the index, right, has been trading one standard deviation above the mean. So in other words, what that means is that investors, and that's for the past decade, so 6 to 10 years. So what that means to me is that investors already expected the gold price to rally. So the question becomes, what is the positive catalyst? Because I cannot see it. If investors already expected the gold price to be in, I'm an efficient market pioneer, I would expect the increase in the gold price to be priced in, right? And that seems to not be the case. And historically, gold has not outperformed, or gold miners have not outperformed at these levels. So that's also really concerning for me. So if anybody has the answer out there, please, I'm open to suggestions. I'd like to understand what the positive catalyst is. But in my mind right now, I'm thinking irrational exuberance. People are just jumping on the train thinking they're going to make 3,500%, as explained earlier in the introduction. So yeah, it's just very difficult for me to justify the momentum in the gold price. So what I did was to make a better case for myself, because I'm doing this for my own common sense analysis and obviously my portfolio, is that I started looking at all the structural issues that are faced by the industry. So yeah, like I said before, the average price of gold, the long-term average is 915 US dollar per fine ounce, and it's been trading above that for 10 years. So why is this significant? Because if you look at the gold mining index in South Africa, even though it's highly levered, so I've explained the leverage effect, despite that, it's still been underperforming all the other indices on the JSE. So that just doesn't make sense to me that it's been trading above its 10-year average for a decade. No, I mean long-term average for about a decade, and it hasn't been outperforming. So then it led me to something of a realization, I guess. I've realized that South African companies in general have been suffering from poor capital allocation and just bad management, without even thinking about it. Two big companies pop to mind, Aspen and Sasol. I mean, we saw both those companies suspending their dividends, and that's just not acceptable, especially in South African context where they actually prefer companies that pay dividends. Very traditional investing. Anyways, I digress again. So just to put that into context, why I think capital allocation has been very bad in South Africa, and specifically with the gold miners. Some stats. Over the past decade, the gold miners as a whole only paid out about 1.6 billion US dollars in dividends. And to put that into perspective, they invested about 26.3 billion US dollars over the same period into capital expenditure and exploration. Now, obviously, this would not be a problem if we saw some capital efficiencies or improvements in gold production, but this has not been the case, not at all. So what we've seen was, if I could give you some numbers, over the same period, total gold production fell by over 22%, so slightly over 22%. And EBITDA, which is your earnings before interest, tax, depreciation, and amortization, that's fallen by about 15%. 15%. I'm sorry about that. This is despite the dollar gold price, which has increased by about 13 to 14% over the same period. So there's just really no positive catalyst coming out of this, and it hurts to say this, even from a gold bull. I do think there's a little bubble here in this market, specifically in South Africa, and yeah, my main conclusion will be that this is irrational exuberance, and it is all dependent on what your take is on the future of the gold price. If you think gold is going to 3,000 US dollars, that might be a good trade idea for you. But I do think that's a bit too optimistic, and yeah, not impressed. Over and out.